it's appropriate to move cautiously and look for progress on inflation. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
That was Chair Jay Powell at yesterday's presser. The FOMC now projecting only 2 rate cuts that are likely next year. This hawkish stance initially sent the U.S. dollar surging to a 2-year high. We're now seeing the dollar essentially flat here in early moves. So we want to bring in Thierry Wizman. He's a global FX and interest rate strategist at Macquarie. It's great to have you here, Terry. Let's talk about the move that we have seen in the dollar. We have the hawkish Fed did send yields higher. Now we have the initial move in the dollar. Looks like things are settling just a bit. I'm curious what you think this tells us just about the trajectory that we could see from here for the U.S. dollar.
Well, it's altogether possible that the dollar can strengthen further. Keep in mind, I'm saying this not just because the Fed was more hawkish. Certainly the Fed was more hawkish. And I think the reason it was more hawkish was because it's starting to anticipate some inflationary pressure coming from the agenda items in President-elect Trump's policies. But the other reason that the dollar has strengthened, and I think this is somewhat underappreciated by participants in the market, is that all the other central banks are sounding more dovish. You have seen the ECB see the imperative of nearly promising that it's going to be continuing to cut rates. You have seen the Bank of Canada cut rates, and pretty aggressively at that, by 50 basis points. You have seen the BOJ delay their rate hikes, seemingly, with the statement that came out last night. You have even seen the Bank of England, although they did not cut or increase rates. They kept their bank rate on hold. We saw more dissent with regard to the hold. In other words, there were people on the Monetary Policy Committee that wanted the BOE to cut. So as the Fed is getting more hawkish, all the other major central banks are getting more dovish. And that is the flip side of the dollar, of the story around the dollar strength. And the reason these central banks are getting more dovish is because they, on the other hand, see the potential for U.S. import tariffs being disinflationary for their economies, even though those same tariffs could be inflationary for the U.S.
And so how does the strong dollar impact the fixed income asset class and investor strategy going forward?
It depends where you look. If you see a stronger dollar in the U.S., and we're saying all else equal here, you would think that it conceivably could bring long-term yields somewhat lower than they otherwise would be, just on the back of the Fed's policy. Why do I say that? Because, of course, a strong dollar does promote some disinflation in the U.S. In fact, that's one of the reasons why the Fed wants to be a bit more hawkish. Maybe it believes that to the extent that it wants to help inflation come down further, it needs a stronger dollar. Can't rule that out. But remember, the impacts and the effects and the events that are going to sway the fixed income market, there's a myriad of them besides what's happening with the currencies. There's the deficit in the U.S. There's the prospect of U.S. inflation independently of what happens in the currencies. Those are things that are going to affect fixed income markets just as mightily as what's happening in the currency market.
Terry, I'm curious what you make just from a global perspective. Obviously, we had the move in the pound coming on the heels of the 3 BOE officials voting for a cut. Then you have the move in the yen moving to the downside after we got this dovish central bank meeting over from the BOJ. What's your assessment there just in terms of, are there opportunities outside?
Well, yes, there is an opportunity, and I think it is somewhat connected to the premise that foreign central banks will be more dovish going forward. That opportunity is really in the stock market. It's the premise that the U.S. stocks have outperformed foreign stocks for so long, and the divergence in valuation has gone on for so long, that maybe we should look for an opportunity for rotation out of the U.S. into foreign stocks, simply on the premise that the Fed is getting more hawkish and it's the other central banks that are getting more dovish, and therefore may perhaps in a better position to help support their equity markets through that dovishness.
Interesting. Okay, and so what type of balancing then should investors be considering as they're looking across the balance of domestic and looking at the U.S. dollar versus other foreign currencies?
Well, it's always good to have a diversified portfolio, and I would never advocate having all of one's chips in one country basket. There is a case to be made for reallocation into Europe in 2025, potentially away from the U.S. that case could rest on a few things, but of course, we're going to need to see the good news for those countries, for the foreign markets come out in 2025. Where could that good news come? It could be conceivably from ceasefire talks in the Russia-Ukraine war, which I think could energize interest in the European markets. It could be that the Europeans, the EU, and some foreign countries, Canada, Mexico, concede to the U.S.'s demands with regard to things that are important to the U.S., like national security issues, like defense spending in Europe. And as a result, we get a situation where we are able to circumvent or preclude the imposition of U.S. import tariffs. If that were to happen, you could see those foreign markets do well in 2025. That could be the basis for that reallocation as well.
Thierry Wizman, thanks so much for taking the time here with us this morning. Appreciate it.
My pleasure.